Hello, good afternoon. You've tuned into MF Corner on CNBC TV 18. I'm Vinnii Motiwala and thank you so much for tuning in. Now, today we'll be putting the spotlight on planning for your retirement and why is it essential to start early. If you are a new investor or investing newly in the markets, should you choose mutual funds or traditional products such as PPFs, National Pension Scheme, and there are a lot of other products that are there for retirement. But what should you be picking up? What would give you one of the best returns, handsome retirement corpus that you're looking for, and a lot more on that. This is what we're going to be discussing today with our guest, Mrin Agarwal, Financial Educator and Director at Finsafe India, joining in with us. Mrin, good afternoon. Thank you so much for joining in with us. While retirement age is surely in the 60s, but you have to start early. Let's start by just talking about the main advantages that are there for choosing a mutual fund for retirement over something that your traditional schemes are there, like a PPF, EPF, NPS. What is it as a better option?
Good afternoon, Vinnii, and it's lovely to be here today. And yes, mutual funds do have a lot of benefits because one, they don't have much of a lock-in. And of course, there are a lot of funds where there's no lock-in at all. And the other thing is the flexibility. So when you look at instruments like PPF, for example, there is a 15-year lock-in. Of course, the returns are limited because it's a guaranteed return. When you look at instruments like NPS also, they're locked in till the age of 60. So, if you're planning to retire early, and I think most people do intend to retire by 45, 50 these days. So then, a product that's locked in till the age of 60 may not really work for you. And of course, the fact remains that mutual funds do have much, much more flexibility as compared to instruments like NPS. Because again, when you look at the NPS, it's pretty large cap oriented. So for an investor who may not want to be completely large cap oriented, who may want to take additional risk given the time frame to retirement, I think mutual funds would be a much better choice.
Okay, thanks for highlighting this risk. And given that, like you're mentioning, all of us want to retire early. If need be, I would want to retire at 35 also if I had the corpus, but that's clearly not there right now. But how do I determine if, mutual funds are suitable for my retirement goals? Everyone will have different goals or different amounts that they want to save. And what is the risk profile? On the basis, how do I manage both these things choosing mutual funds?
So of course, everything depends upon what is the time to the goal. So what is the time to the retirement, right? And of course, if the retirement is going to be in the next few years, then you cannot do equity funds, right? Okay. Then you'll have to basically stick on with debt funds. But certainly if your holding period is more than 7 years, so which means that you're going to retire anytime after 7 years, certainly you can start looking at equity mutual funds. And of course, within that, you would want to look at funds based on your own risk profile. So, if you want to, the sort of allocations that you would do between, let's say, large cap, mid cap would be, of course, dependent upon your own risk profile.
Okay. Mrin, like you're mentioning, right, depending on how many years you have till your retirement or your goal of the retirement corpus, what should one be picking up in types of mutual funds, right? You mentioned debt for a certain type of fund. There is hybrid, there is equity, there is retirement-specific funds as well. So for different stages of retirement planning, could you help us how they should be going? If I have more than 10 years, what I should be doing? And if I have 5 years, like you were saying, short-term debt is better. But highlight us in terms of the years that I have till my retirement and how I should be planning that.
Yeah, Vinnii, one of the most common mistakes that I see people doing or I've seen people doing or asking in the last 5 years is that I've seen a lot of people who are like, let's say like 3 to 5 years to retirement. And suddenly equity markets have started doing well and they feel, okay, let me move a large chunk of my money into equities for my retirement corpus, because also, many times what happens is that you're trying to play catch up, right? Like you don't have the required requisite corpus, right? So I think, very importantly, like with every goal, you must always remember that equities are meant for the long term. And only if you have 7 to 10 years and above remaining for retirement, should you actually look at equity funds? Clearly, if your period is less than 5 years, then it has to be debt funds. Again, 3 to 5 years sort of a period, it has to be a short duration debt fund. For all of those who think that, we can actually put money in equities, earn a great return in the next 3 to 5 years and build our corpus, I think that strategy is like really fraught with risk. And if their retirement, for example, was in March, then they would have seen the effect of that strategy, right? So very clearly, greater than 7 to 10 years, it has to be equities. 5 to 7 years, they can look at balance funds, and anything less than 5 years clearly has to be debt funds.
Okay. Mrin, I'm going to ask you two questions, two-part question. One is, how important is age, that you start investing in terms of your retirement planning? And also, for someone who's in their 30s, you want to invest, make money for now also, you want to save for retirement also. What should one be doing, right? How much should go into maybe my retirement side of fund? How much should go into my other mutual fund portfolios? What is the division? How do you actually manage that?
So, of course, starting early always helps, because then you have time on your side. You're letting that money compound. Basically, you're giving time for that compounding to happen. So certainly, somebody who's going to start early, first of all, for the same amount of corpus required, first of all, that person can invest a lower amount of money, right? As compared to, let's say you start at 25, and you can invest a smaller amount, but because you have longer time for it to compound, it'll still grow to a much larger amount, versus you start after 20 years. First of all, you have to invest a higher amount, and then because you have a lower period, the end purpose that you're going to try and achieve is still going to be lesser, right? So starting as soon as you start working is actually the key, because there you can even start with smaller amounts. Now, in terms of how much allocation, see, one thing you should always remember, that retirement is always a mandatory goal at any age, because there's no loan at retirement. And I don't think, that we're going to have anybody that we can really fall back on in retirement financially, right?
Yeah.
So certainly, it's a mandatory goal that everybody needs to have, and it is actually the first goal that you need to be saving for, irrespective of anything else, right? So there are many retirement planning calculators available online, where based on your current expenses, you can actually figure out what is the amount that you need to be saving every month to build a good corpus. And, generally, Vinnii, I'm telling you that for today, for anybody living in a big city, I would say that the corpus is going to be anywhere 6 crores and upwards, right?
Right.
For most people, it's going to average at least 6 to 8 crores. So, if you have to build that sort of number, you need to start right away.
Absolutely, really need to start right away. That number seems very far away right now, Mrin. Is there a specific diversification that someone should start, maybe in their early 30s or late 20s? Is there a way that one should be following? Like, I can invest so much in debt for my retirement, so much in equity for my retirement, and then keep shifting. Is there a way to do that? Is that something necessary to do, or maybe just stick to one?
I think you should just do 100% equity, because again, given that gap, the corpus requirement is huge, and the amount that one can invest is, limited, given the fact that you have to run your regular expenses and you need money for other goals. So given that, the only other option is to look at taking a higher amount of risk and hoping that over a period of time, the compounding effect will actually come in. So I would actually say that certainly if you're in your 30s and you're investing for retirement, just in any case for the salaried people, the EPF provides the debt component.
Yeah.
I would say that whatever else you're investing should be 100% equity, and it should be aggressive equity. So look at mid cap, small cap, for example.
Absolutely. So that's interesting there. Mrin, I just want to, confirm in terms of, is there a minimum investment requirement that comes in, or it's like normal mutual funds, even for retirement mutual funds that you would follow? Also, taxation point of view, is there a difference if I'm, buying a mutual fund, when it matures during my retirement, what is the taxation there? And PPF, EPF, NPS, if I would go to, what is the taxation for both these point of views?
So the minimum is going to be like any other mutual fund. Now, the taxation is also going to be like any other mutual fund based upon which fund you choose, of
Yeah.
course, right? Whether it's a debt fund or it's a
Hmm.
balance fund or it's an equity fund. PPF, of course, is tax free. When you look at EPF, EPF is also, of course, tax free. But when you look at the national pension scheme, the 60% that you get at the age of 60 as a lump sum is tax free. But the 40% that you annuitize, the annuity or the pension that you get is actually fully taxable. As far as equity funds are concerned, so for example, if you decided to go in for an equity fund, the same taxation is going to apply, which is after 1.25 lakhs, the tax is going to be 12.5% after 1 year, basically. So it's going to be the same taxation if it's an equity fund.
Okay. Thanks for clarifying in terms of the taxation point of view as well, because everyone's worried about what money I'm going to pay out of this, if I start redeeming. So thanks for that. But Mrin, on that note, we're going to slip into a very short break. So do stay on with us, and viewers, do stay on with us, because we still have a lot to discuss in terms of what sort of funds also you all should be selecting, and a lot more on this after the break. Welcome back to MF Corner on CNBC TV 18. We are discussing how you all should be planning your retirement, your goal, your corpus with mutual funds for your retirement. Mrin Agarwal is still with us to discuss all of that. Mrin, how is a retirement-specific mutual fund different from regular equity funds or hybrid funds? What should I be picking up, right? And does that matter at different age groups? You have to pick up different sorts of funds. Should I just go for retirement fund? Also, does the return vary in terms of both these situations?
So I would, so what's a retirement mutual fund? So these are specific solution-oriented funds that exist from mutual funds. And basically, there's a lock-in of 5 years or retirement, whichever is earlier, right? Now, these funds, they have different types of schemes that are available even within the retirement funds. So you've got equity funds, you've got some funds which are managed like balance funds as well, right? And, I think these funds work really well for people who want to say that, okay, I'm investing for my retirement in this one specific product, which I will not touch because it's a retirement fund, right? But you know what? You can invest in any equity fund, you can invest in any balance fund. And when I actually look at the returns, right, I do see like just at a category level, and of course, I do want to say this that at a category level, sometimes, the returns can look a little different because you're doing an average of equity schemes as well as balance scheme. But again, when you look at the returns, I somehow find that, the regular equity funds, the regular regressive hybrid funds are just good enough without you really having to get into a specific retirement category, right? But if you feel, okay, there's this specific fund, it's like this mental accounting, right? So if there is a specific fund that I want to allocate specifically only for retirement, then of course, you could look at the retirement category. But I have seen that the general categories have a better outperformance, and I think it's because the retirement category of the retirement mutual fund or the solution oriented mutual fund is more conservatively managed.
Okay, yeah, absolutely. I'm sure they'll be managing it more conservatively because they want to save a lot more money. And 5 years is the lock-in period, right? You've highlighted for these retirement funds. Any pick that you have in any of these names, if they're looking at a retirement fund, they're okay being conservative. 5 years means even if you're 50 or something and you want to retire by 55, 60, you could look at those funds as well, right? Because lock-in is only 5 years.
Yeah, so I think the HDFC retirement fund would be a good choice.
Okay, thanks for that, Mrin. And what are the pros and cons that one should be using? If I'm like you're mentioning, right? Hybrid funds, balanced advantage funds. There are so many of these options there, because then there's a wide range of it. So, pro of any of these normal mutual funds and a retirement fund, pro and con there.
So I would say that, the retirement mutual funds, as I said, they're more conservative. And, you have that thing in your mind that, okay, this is for retirement. And so you're unlikely to touch it for other purposes. What happens with the regular mutual fund is that it's going to be one of these schemes which is there in your portfolio. And very likely, what happens is that investors always look at performance, the recent performance, and they might utilize the fund for some other purpose and stuff like that, right? So I think it's really about the discipline that the investor can actually maintain. Like if they can say, I'm buying this equity fund, you could just buy a Nifty 50 index fund and say, I'm going to hold it for the next 20 years for my retirement. But that needs the discipline, right? That you're not going to touch it tomorrow if you're going to see, like, for example, small caps performing, or like if you need the money for something, So I would say, look, you can choose either, though my choice would still be the regular funds that are available. But it's all a question of how disciplined you can actually be with that investment.
Okay, discipline is key, right? If you are too whimsical and you want to move in and out, then better just buy the retirement fund, because that will be easy to help you save for your retirement goals. Okay, that's the word there. But options that are there during from mutual fund side, when I want to generate regular income, especially after my retirement, right? Like maybe monthly something I want, or 6 monthly some amount I want. What are the options available over there?
So, of course, you have the systematic withdrawal plan available. And I think I had done a recent show with you all on the systematic
Yeah.
withdrawal plan. And, one point that I really want to highlight is that it's a great option that exists from mutual funds. But remember that you need to do it from a debt fund and not an equity fund, because equity funds are really volatile. And let's say you have a 10% drop in the markets and your corpus is going to fall by 10%, then all the calculations that you have made will have to basically change, right? So, see, the SWP needs to be done from a fund which is going to give you more stable, predictable returns. And hence, the short duration debt funds are best suited for the SWP. That would be my suggestion.
And then how should I divide this amount? If you could just specify how much then should go to equity as an investment for retirement and debt as an investment for retirement.
So, the way I would do it is that I would actually invest. So, let's take an example of somebody who's got, let's say, 15 years for retirement, right? So, the way I would do it is that the first 10, 12 years, I would be in equity 100%. Because, as I said, we're assuming that the person is salaried also, in which case you anyway have the EPF, which is giving you the debt exposure. So, what I would actually do is that the first 10, 12 years, I would be in equities. And then I would move it into a short duration debt fund for a 3 to 4 year period, and then start the SWP. Because, if you just invest and you're going to start the SWP right away, that's like then taking out money from your capital itself, right? So I would actually plan it in this particular way.
Okay. Mrin, what I want to know, like you're saying, right, to shift the funds from equity to debt, is it easily doable or easily to actually transition from equity to debt? Or, how does the process actually work? Is there an amount of tax component that comes in when you're shifting around as well?
Yes, of course. Any transaction that you do, when you do an exit, there's always going to be a tax component. I mean, it's pretty easy to do a switch from an operational perspective. But I think, investors would need the help of an advisor to really help them set this, do this SWP strategy and set up the SWP. Because, one of the things in the SWP is also to then work out based on the corpus, what is the amount that you can remove every year, where it can last for a longer time.
Okay. Mrin, how often do I need to review or rebalance or keep looking at my retirement side of funds, right? Because this is what, like you said, you can hold an index fund for 10 years, then you're good to go, because you don't have a lock-in period in your normal mutual funds. How often do I keep reviewing it? And what if it's not matching the returns that I want? Then what should one be doing? Because 1 year could be up, another year could be down as well.
Yeah. So, I mean, of course, you can check it once a year. But again, the idea is that when you invest, get the fund right, because, you want to get in with, let's say, a 10, 20-year time frame in that investment, right? So, ideally, you should look at funds that you can actually hold on for the long term, where you don't need to be getting in and out. And I think the only reason to exit the fund should really be massive underperformance, right? So, other than that, and which is why getting the fund choice right at the beginning is very, very important, and making sure that you say to yourself that I'm going to be using this fund for retirement as well, so that you maintain that discipline also.
Okay. Mrin, what are the most common sort of mistakes that you've seen investors make when they are using mutual funds for retirement, and how is it that one should avoid them?
So, one thing, of course, as I highlighted, is that people are using equity funds for SWP. And I think it's not a good idea because of what I explained on the whole volatility aspect. Even in debt funds, you need to get the category right. So, of course, I see a lot of investment getting into gilt funds just because gilt fund performance has been good, or let's say credit risk funds and stuff like that. So, again, do remember that if you are investing for it, for your post retirement regular income and stuff like that, it has to be in a more conservative debt fund. I would not look at categories like gilt funds or credit risk funds for that purpose, again, for the SWP purpose. And one more thing, which is not really mutual fund related, but I do want to highlight it because I see a lot of investors looking at this, that right now you have a lot of high yielding corporate bonds that are available on various platforms. I would be very wary because, when I look at the credit rating of these bonds, they are all, I've seen like triple B minus. And
Yeah.
investors should remember that mutual funds invest in bonds rated A and above. If you look at most of the mutual fund portfolios, it's triple A and double A bonds. So I would, just caution saying that if you want the regular income, stick to the fixed deposits, or some of the government schemes like senior citizens and stuff like that, and then work on the SWP. Do not fall for this trap of this
Sure.
high corporate bonds. I would just like to caution them on that.
Absolutely, Mrin, thank you so much, for cautioning our viewers what they should be avoiding while making their retirement corpus funds as well. So thank you so much, Mrin, for joining in with us on the show today, explaining us how we should go about the process as well, when to start. Earlier, the better, obviously, but thank you so much for that. And thank you so much, viewers, for tuning in to CNBC TV 18. Up next, your closing bell to take you through the last hour of trade, so don't go anywhere.